So let's switch gears and talk a little bit more of a price question. In previous videos, we discussed the idea of the difference between intrinsic values and market prices. So market prices are based on the analysis of investors and their trading of the securities. Intrinsic values assume that we know everything there is to know about an asset. So the right-hand side here are the intrinsic value. All the information that's out there is in this intrinsic value. The challenge is we don't have all that information. What we have is selected information and its interpretation. So that provides us with perceived future cash flows and perceived levels of risk. So intrinsic value will hardly ever be equal to market price because they don't contain the same level of information. So what is required for the market to be in equilibrium? The theory of capital asset pricing model, in fact, most theories in finance, assume that the market is in equilibrium, that the values would be equal. Again, the market price of a security equals the security's intrinsic value, right? But only if it has all the same information in it. So the expected return on a security then must be equal to its required return. So again, in equilibrium, price and value are the same, which means the returns are the same. How can we get to equilibrium? What if they're not equal, right? When would we even know if they're not equal? So if the market price is below the intrinsic value, then we know that there is potentially a bargain. But again, how do we know it is there? If we perceive that they're not in equilibrium, this implies that we see value not expressed in the price. We see an opportunity. This is how trading happens. People's perceptions of the data that they have are different, which implies they have different values that they attach to the assets. When we compare that to the price, that implies opportunities to either buy or sell. So if as an investing public, we perceive an optimistic future, then we see value. If we all begin to purchase, the demand for that security rises, and then so will price. The efficient market hypothesis implies that prices include all the information about the security. If this is true, there's no difference between intrinsic value and actual value. When information is presented to us, the public, we trade. So stocks are, again, normally in equilibrium. If that is true, since intrinsic value and actual value are the same, we cannot beat the market by consistently earning a return higher than is justified by that stock's risk. Now, this doesn't mean no return. It just means you cannot beat the average stock in the stock market. So how can we test this efficient marketing hypothesis? We need to choose a trading strategy and then implement it. We pick an asset pricing model like the capital asset pricing model, and we measure the required return of the strategy's investments. We measure the actual return, compare that to the required return. If the actual return is greater than the required return, then we would reject the efficient market hypothesis, saying that I could get a higher return. Now notice that this is what they refer to as a joint test of the efficient market hypothesis and the asset pricing model. if the test rejects the efficient market hypothesis, it could be that really it's the asset pricing model that's wrong. So again, this particular model has some issues with trying to understand its importance and its relevance in the marketplace. The weak form of the efficient market hypothesis says that if markets were efficient, using historical data would not provide us with higher than average rates of return. So again, current prices already reflect all the information in past prices. So you cannot earn excess returns using strategies using past prices. So for instance, if you invest in stocks that have declined below their previous 52-week low, that's a type of technical analysis. Let's follow that strategy, see what kind of returns we get. We need to compare those returns to the returns that are implied by the capital asset pricing model, for instance. Most empirical evidence supports this weak form hypothesis because very few trading strategies consistently earn in excess of the CAPM prediction model. Now, there are some small excess returns for some trading strategies. Short-term momentum and long-term reversals, those types of trading strategies beyond this course, can frequently give us higher than average rates of returns. However, when we add taxes to the mix and commissions to the mix, those returns typically quickly disappear. The semi-strong form says if we're using all public information, so we're going to use that, we could use historical information, but we also could use current events. The efficient market hypothesis says using even that kind of information, you cannot earn excess returns than average over the stock market. So now if we wanted to invest in stocks with past 3-year annual growth greater than 10% and a ratio of research and development to sales greater than 10%. And this is a type of fundamental analysis. The efficient market hypothesis, using the semi-strong form, says, using that strategy, comparing those returns to those of the required by the expected by the capital asset pricing model, you will net get above average rates of return. In this case, there is a mix of results. There are many studies that show that you cannot earn excess returns. However, there are a couple of exceptions to this. One is small companies. It turns out that small companies tend to earn higher risk-adjusted rates of return than larger companies. In addition, companies that have high book-to-market ratios, again, a high book-to-market ratio implies companies that have lower numbers here. That basically says if you invest those kinds of companies, you would not be able, or you could, from time to time, beat the stock market on average. Again, once we add taxes and commissions, most of these returns disappear. Now, the strong form efficient market hypothesis says if you had all the information, every piece of information you get, both public and private. So if you had inside information, you could not beat the stock market on average. Now, what we would find with this, I think, hopefully it's common sense, but it says, look, if you know who's going to win the race before the race is won, you should bet on that person, right? Because you'll always be right if you know who's going to win ahead of time, right? So again, this is actually kind of a reason, I guess, for why inside trading is illegal, because it's not really investing if there's no chance of loss. So even these strategies provide some returns, but again, when you apply taxes and commission, the returns do have a tendency to quickly disappear. So there are things out there called bubbles, market bubbles and market efficiency. So market bubbles challenge this idea. Most recently, we had a company, GameStop, in 2021, where retail investors drove the price from under $20 to over $300 within weeks. This price surge wasn't based on fundamentals, but on social media momentum. Eventually, the bubble burst, reinforcing the idea that markets aren't always efficient in the short term. So while efficient market hypothesis works well under normal conditions, there are some events that highlight the role of speculation and emotion in distorting prices, at least temporarily. If there is a bubble, though, why don't traders take positions that make big profits when those bubbles burst? The challenge is it's hard to recognize a bubble until after it does burst. Then it seems obvious, right? So trading strategies often expose traders to possible big negative cash flows if the bubble is slow to burst. So what's the bottom line for market efficiency? In general, prices we see represent a fair value for the asset, or it would change. Investing in index funds can take the risk of below market returns. However, they also can eliminate the chances for above market returns. So investing in the general stock market gets you the stock market. It can't get you more, and it can't get you less. What about the relationship of the capital asset pricing model? What does that tell us? This model is held for many decades. There are many variations. In our readings, they mention here something called the Fama-Macbeth multi-factor model. So statistical tests have problems that make empirical verification or rejection almost impossible. Investors' required returns are based on future risk, but betas are calculated with historical data. Investors are concerned about both standalone and market risk. So the actual statistical studies of the capital asset pricing model have challenges. However, it is the easiest model, and it makes the most common sense, even in its more varied models recently that includes more variables than just beta. So that's the end of our discussion on risk and return. In future videos, we're going to switch and start talking about securities. How do we now apply the time value concepts, the risk and return concepts to these future securities of the company? Look forward to seeing you next time.